For those people watching this, give us a quick overview of what is a 1031 exchange.
The 1031 exchange just refers to the section of the IRS tax code that says that a taxpayer can sell their investment or business use property and defer having to pay their capital gains tax by using the services of a qualified intermediary such as myself to hold the funds in trust for them until they're ready to reinvest into another investment or business use property. And the real beauty of an exchange is that it's not a one-time benefit that you get. You can exchange for as long as you live for as many investment properties as you have and continue to kick that tax bucket down the road. And, we say swap till you drop, which just means keep kicking the bucket till you eventually kick the bucket yourself. And under current tax law, your heirs will receive what's called a stepped up cost basis to market value, which simply means that they don't have to pay back the capital gains tax that had been previously deferred by the prior owner. So it can be a really great tool for wealth building and for wealth preservation.
So an example is mom and dad bought an investment property 30 years ago for $200,000. And it was a duplex in San Francisco, let's say. I don't know if my numbers are completely off, probably. But let's just say duplex, San Francisco, $200,000. 50 years ago, that's probably more realistic. They bought it when they were just kind of starting their family, and now they're approaching their retirement. And so they're ready to sell. They're tired of the maintenance issues and the tenants and dealing with some of the, let's just say, additional rent control that exists in San Francisco. And they're just ready to sell it, convert that into another investment that is probably going to have a better return and be a lot less maintenance and a lot less hassle for them. So the market value now of that property, let's say, is $2 million for easy math's sake. The commission that a real estate agent charges is 5%. Let's say that includes their closing costs. They're just for easy math, but closing costs would be roughly, let's say, 20%, city transfer tax and all those kinds of things. Sorry, $20,000, not 20%. They're selling for $2 million. And their total fees, including everything, will be $100,000. For ease of everything, they're not putting any money into it. They're not remodeling anything. They're selling it completely as is. Tell us about that scenario and kind of what it looks like. What is their gain and what is their timeline now to get the next property? Let's kind of start creating a little scenario for people.
So in this case, they bought the property for $200,000. They're selling at $2 million. And as it was investment, they also have the ability to depreciate it. It's been fully depreciated. So now we're looking at a pretty sizable amount of gain. And let's just use simple math and say now that they have, they've depreciated $100,000. So they have $100,000 basis. A $2 million property. Well, without a 1031 exchange, they're going to recognize the full extent of that gain of $1.9 million, and they're going to pay taxes on it. And capital gains tax will vary anywhere between 25 to 42%, depending on once that gain is applied to their adjusted gross income. So you can imagine paying taxes on 1.9 million, figure about a third of that might be what you're paying in taxes. So exchanging is going to allow for you to defer all of the capital gains tax on that 1.9 million. And so now you're going to sell this investment property and you're going to reinvest into another investment property. And once that closing occurs on the property that you're selling, that's when the timeline for the exchange begins. And you have 45 days from that date of closing to identify in writing the property or the properties that you're intending to buy. And you have 180 days from closing on your sale to complete the purchase of what was identified in the first 45-day period. Now, that first 45 days will feel a lot like 45 seconds when you are in the middle of an exchange, and it is the absolute shortest 45-day period known to man. And so when you look at the exchange value in terms of what you actually have to spend to fully defer the capital gains tax, it's actually based on the net sales price, not the gross. And I often hear, well, don't I just have to reinvest my gain or my profit? And that's not accurate. So the exchange value is always based on the net sales price, which in this case is going to be that $2 million minus the closing costs and normal cost of sale expenses. So in this case, we figured about 5% in expenses to sell. So that's $100,000. which now leaves them with a net exchange value of 1.9 million. They would have 1.9 million to reinvest into another investment property. And if they buy below that 1.9 million, it's not going to ruin or negate the exchange. It's not all or nothing. If they buy down in value, they're just going to pay tax on the difference between what they needed to spend versus what they actually spent. So if they need to spend 1.9 and instead they buy at 1.5, they're just going to have tax on that $400,000 difference,
which is called the boot.
That's the boot, and not the kind of boot that I like.